What's up, guys? We have got another fun-filled video for you. All right, more sarcasm, I'm sorry. But you gotta know financing for the real estate exam, so that's what we're gonna do. We're gonna know financing. In this video, I'm gonna show you what's gonna be on the financing portion of this exam. Let's get it popping. Numero uno. Insurance required by lenders when a home buyer can't make a 20% down payment, which it protects the lender. The more mortgage you have, like if you have like a 99% mortgage, they don't do those anymore. They did when I bought my first house. But you know, all the risk is on the lender. The more down payment you put on the asset, the less risk the bank has, right? So if you do less than 20%, there's an insurance fund that the banks have, and that's called what? Okay? Is it protection mortgage insurance, private mortgage insurance, public mortgage insurance, or none of the above? All right, if you've ever bought a property and you did not have 20% to put down, you probably know this because it's a line item on your mortgage statement, and it's called PMI, private mortgage insurance. All right, and so I already explained it, so we'll keep going. But there's the long form version if you want to read that. A metric used in commercial real estate to assess a loan is equity ratio, loan to value ratio, mortgage risk assessment, capital exposure factor. So loan to value ratio. Loan to value ratio is basically if you get an appraisal done and a property's worth $1 million and they loan out $800,000 of that $1 million valuation. That's the ratio, loan to value. So that would be 80%, right? Loan to value, 80%. Does that make sense? I think so. I hope so. Next, lender assessment of a borrower's creditworthiness considers finances, property value, and risk before approving a loan is called underwriting, loan approval process, credit pull, or none of the above. What do you guys think? The lender assessment of a borrower's creditworthiness. I'm trying to think of how to make this easier for you guys to remember. So it's an underwriter, right? So this is called underwriting, and an underwriter at the bank has this job to make sure that there's as little risk for the bank as possible. That's the job of an underwriter, and they do underwriting. There's the long form version. If you want to pause it and read that. If not, let's keep going. All right, so question 4. Real estate investors pooling resources to purchase and manage properties. Enhancing affordability is called what? I'm actually a part of a few of these, and we use them to build apartment complexes. We use them to buy apartment complexes. And the word that we're looking for, so it's collaboration, joint venture, joint tenancy, or syndication. And this is a syndication. It's probably one of the best things you can ever be a part of if you are an accredited investor. You can get really good returns on these. I absolutely love them depending on who's in, but if you're just starting your real estate career, you're a long way from investing in syndications, just my opinion. And so a syndication is a collaborative approach to real estate investing. In this arrangement, a group of real estate investors pull their money, their expertise, their capital, our minds, and we work together and we build something great, or we buy something great. Love, 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 love syndications. All right, next question. A short-term loan for buying a new home before selling the current one, or using the current's value as collateral is called what? This one, you do not see this word very often. So I would not put this in the common sense category. I would say this is one that you just you got to write it down, make a note card, right? So this is called a bridge loan. And so a short-term financing solution, I mean, think about a bridge. So we're going from here to here, and we need something that's going to get us from this point to this point. It's called a bridge loan. So there's a little common sense there, after all. So the bridge loans are only short-term loans, and they're very expensive because there's a lot of risk, right? All right, when an investor buys a home, but the existing mortgage stays in the seller's name, typically in foreclosure or when the seller's behind in payments, this is called a what? All right, if you guys, I'm gonna age myself here, but in the 90s, you guys might have seen these real estate commercials all the time talking about subject to real estate. And this was huge in the 90s. And you still see it often, but in the 90s, it just kind of blew up. It got really, really popular. But subject to real estate is a real estate transaction where the investor acquires a property while the existing mortgage remains in the seller's name. So you can like take control of an asset while the risk is on somebody else. There are instances where it's good for the homeowner, but it's very few. It's great for the investor. I have not personally been a part of a subject to, but I know people that have, and they've made a lot of money. But yeah, you just need to know this for your real estate exam. You're not interested, or maybe you are interested in making money in real estate in other ways down the road. But subject to is a very, very interesting strategy. I really like it, just never been a part of it. All right, pledging an asset as collateral for a home loan, securing the loan is called what? So what is I'm trying to think. So you guys probably know this one, all right? So if you go to a not a flea market, what do you call it? Pawn store, like a pawn shop, all right? And you need money, right? I don't use them. I think it's kind of a crazy from a financial standpoint, but I understand why they exist. But so let's say you've got to have $1,000 today. You've got to have it. You don't have it, you got to have it. But at home, you've got you've got a gold coin that your grandfather gave you that's worth $5,000. All right, you can take that coin, but that coin's got value to you, so you don't want to let it go, right? So what you can do is put it up as collateral. So you take it to the pawn shop, you give them this $5,000 coin, and you say, I gotta have $1,000 today, please, 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 please. And he says, okay, I'll let you borrow $1,000. You gotta pay me back with interest in a month. And if you don't, I'm gonna keep this gold coin that's worth $5,000. And so you gotta pay it back. But that gold coin is called collateral, right? So collateralization is that process. And I think you guys have probably heard that word before, but I'll remind you. Next. Oh, there's the long form version. Yeah. Maybe I keep giving you guys like my personal version. Maybe I should stop doing that. Just let you read the boring stuff. What do you prefer, my stories or the boring stuff? All right, next. A metric in commercial real estate for assessing project financing risk by comparing the loan amount to the project cost is called what? Let's think about this. So the cost approach, that's an appraisal term, all right? We're not talking about appraisals. Loan to value ratio or loan to cost ratio. So it tells you, it's got the keywords in the question, loan amount to project cost, right? Not to value. Like if I spend $10 million building an apartment complex and that apartment complex is only worth $10 million when I finish, I've wasted my time. I've wasted my money because all this time is just wasted. But the loan to value, so if something costs $10 million to build, it's going to be worth $15 million, maybe $17 million, right? So that's the loan to what it's going to be worth, right? Not what it costs to build. So you're at zero, it costs $10 million to build it. After you're finished, it's worth 15. Does that make sense? Whatever. Could be 11, could be 12, depending on how good you are as a real estate developer. LTC is a key metric used in the context of commercial real estate development. It is employed during the construction of a new building to gauge the level of financing required for the project. I have seen projects I've not been a part of, unfortunately, but I have done projects where the construction costs were $7 million and the stabilized value, which means after they're complete and the property's leased up, is worth like $20 million. You can see how you can make crazy money in real estate. That's why I freaking love it. Okay, a blank allows borrowers to settle their outstanding loans with incurring additional fees or penalties. Is it due on sale clause, default, acceleration? What do you guys think? Look at these and tell me what you think. Okay, so the answer is B. All right, so I don't really have any good stories about this one, so you're just gonna have to read what we got here and learn it. I'm sorry. I'm trying to think of some personal stories to help you guys understand this. This is one of those where you just need to break out the note card, write it down. It's a boring term that you gotta know. All right, question 10. A public notice in court indicating mortgage borrower default. The precursor to foreclosure is called what? All right, so this is what happens in the courthouse before we're foreclosed. I mean, to me, this is kind of a common sense one. Well, they've got it kind of tricky. This one's kind of tricky, but it's also kind of common sense. Because you are delinquent, but you're default. That's what it is, notice for default, an NOD. All right, it's the final warning before the borrower takes back the property. In 2008, this was going crazy. I was there. I was buying. I was buying as much as I could. All right, a mortgage with a variable interest rate after initial fixed period offering potential rate advantages is called what? Wow, do I have stories about this? All right, variable interest rate. You guys remember the movie The Big Short? A lot of them got in trouble because of stuff like this. Right now, so this video, when this video is being filmed right now, interest rates are going through the roof. And so where a lot of people are going to be in trouble in the next year, you have these borrowers who borrowed money on a property at a 2% interest rate. And let's say their monthly payment is $2,000 a month, right? Interest rate's 3%. Well, now we're at 7%. Okay, so that interest rate's more than double. I mean, the monthly payment's more than doubled, and so depending on how much money that property was making, they can't make the payment. It's a big problem coming in the next next year for sure. In the next year, it's going to hit the fan. We just hope interest rates drop before that happens. If you got more questions about that, I really enjoyed talking about that, so put it in the comments, and I'm happy to help. Oh, so yeah, so it was an adjustable rate mortgage. There's the textbook definition. Very dangerous product in my opinion, but a lot of people have used them to make tons of money. You just gotta be careful. A loan that combines a mortgage with funds for property repairs or updates, excluding luxury upgrades, is which? And I have done one of these through HUD. It's FSA, FHA. Yeah, I did one of these through HUD. I did one of these through so they basically give you loan to value instead of loan to cost. But anyway, let's just go through it. A loan that combines a mortgage with funds for property repairs or updates, excluding luxury upgrades, is called what? The FHA 203K rehab loan. This is phenomenal if you want to buy a property, by the way. It's designed for properties in need of repair. So you can buy a property. In my case, I bought a foreclosure property for my personal home that needed tons of work, and I didn't have the money at the time to pay out the fees to do it. So I got this special rehab loan that the government offers. It was amazing. It was phenomenal. But that's the 203K rehab. Okay, government insured loans reducing lender risk for borrowers with lower credit or down payment are. So a VA loan is VA Veterans Affairs for people that were in the military. Veterans for the military, they get a special loan program. But this one is talking about the FHA, okay? Federal Housing Administration. FHA loans are part of a group of loans that receive federal government insurance, reducing the risk for lenders when lending to borrowers with lower credit scores. FHA. You'll see a ton of FHA loans as a real estate agent. A lender issued document indicating loan terms and amount a buyer qualifies for based on the financial assessment is called what? So remember the letter that you get to prove that you're ready to buy? What's that called? A pre-approval letter. So this lets buyers know that you're not wasting their time, because what happens sometimes is, let's say I've got $1 million home for sale, and you make $20,000 a year. I don't know what you make. You just bear with me. $20,000 a year, and you want to see my house. That's a waste of time for me. That's a waste of time for you. It's a waste of time for the agent. It's a waste of time for everybody because you can't afford the house, right? But with the pre-approval letter that says, okay, this person already has enough money. We already approved him for the mortgage. Boom, he can buy your house, and it makes everything flow much better. All right. Oh yeah. I already explained that. There's a textbook term if you want to pause it. Next question. Government guaranteed loan for eligible military. Oh, I think I gave this one away earlier. Were you paying attention? Government guaranteed loan for military personnel and some spouses offering low to no down payment and competitive rates is called what? The key word is military, right? VA, Veterans Affairs. I've done tons of work with the VA. Love the VA. All right, and that's it, guys. Thank you for watching this video. If it was helpful, drop a like, drop a comment, drop something. Tell me. All right, guys. Have a good day. Bye.